Welcome to Market Movers. I'm Dave Hightower, joined by Dan Bosse. So the weather may upstage the June crop report. We have went from a fairly quiet market to now a significant market and maybe even a historical market. How do you see it?
David, it's absolutely crazy when you think in the last 2 weeks we've shifted the markets thinking entirely away from U.S. and China trade now to Mother Nature. And so farmers are struggling to get seed in the ground. Here as of last Sunday, May 26th, we still had about 100 million acres of corn and soybeans left to plant. And the market will have to think forward as to what that will occur. WASDE, in their report forthcoming, will not get a lot of that right. They will be, of course, seeing the NASS report on the 29th of June, the seedings report. They don't want to get upstaged, so they'll be tinkering and very conservative. So I don't look for this report to offer a bullish jolt. More importantly, it'll be a start to see where the plantings will be in a wet weather year.
And they typically don't like to enhance volatility or anticipate some kind of historical problem.
You're exactly right. So when we think about this report, don't look for it as being market moving. Bigger report will be later in the month at June stocks and seedings numbers.
So the condition in the marketplace is low prices already had a lot of problems for the farmer. Now we've got the prevent plant figured into the equation. That's going to play large in the market, is it not?
Well, I think prevent plant is somewhere in the equation. I say that because I see estimates as low as 3 million acres and I see them as high as 12 million acres. That's a big swing in terms of corn production. That's 500 to 2 billion bushels in terms of lost corn production. The problem with prevent plant is we won't see those numbers from the FSA till sometime in August or September. So the market's got a lot of dancing to do here before it really understands exactly what the farmers have planted or not planted.
So beyond prevent plant, though, the later we get, that does have an impact on yields.
It does. There's yield drag, of course, for late plantings, and we got 100 million acres to go in the ground as of June. So this will definitely have a drag on yield, but we also can find those years in which if weather is favorable in summer and we have an extended fall, that yields still make it the trend line. So it's going to be a market that takes everything day by day, week by week in terms of Mother Nature and what she's offering us.
And a contrarian might indicate if you do get it in, you got a lot of moisture in the soil. So before we dive into our trade discussions, I'd like to point out that these trades are examples and not recommendations or advice. So Dan, weighed in on us.
So David, my trade is I want to look at buying a Dees 21 corn futures, selling a Dees 2020 corn futures at even money. I'm going to risk 7 cents with the Dees 21 premium of 24 cents down the road. What's happened here is that the old crop has run to the upside, dragged the new crop in terms of 2020 and 21 corn futures to even money. I think it's an opportunity because next year farmers are going to plant more acres of corn.
And looking to benefit from that change in big picture situation. So Dan, as an example, I'm buying December 19 corn futures at the market and buying 3 July corn 415 put option for 11 cents each. I want to risk 6 cents on the combination, have a target of 19 on the futures, but my hope is we get a continued rally off the remainder of the delays in planting, and maybe those put options could come back before their expiration and maybe give me a nice gain. I want to hold those puts into a setback and into expiration.
I like that trade, David. You know, the one thing that's going to happen in the market is we all know that short crops have long tails. So when we get the supply digested, that should be the high in the market, the supply loss.
Well, at least we've changed the equation, and maybe it'll help the farmers in the end. So Dan, on Market Movers, we like to educate new folks just tuning in. And this time, what is prevent plant insurance?
Well, David, when you buy your revenue insurance each March, and I'm now talking about corn and soybeans, you have the optionality to buy prevent plant. This means that if farmers are actually prevented by Mother Nature from getting into the field, they can get a percentage of their money back in terms of paying for seed and some of their inputs. And so how prevent plant works, if you get to key final dates on corn, let's say it's May 25th, May 31st, and June 5th, those are the key dates across the Midwest. Those are final planting dates. After that date, you lose 1% of your revenue insurance per day. Up until then, of course, you then can take the prevent plant. You have to inform your agent. He will then tell you that you get the $4 price on your insurance. You then, depend on what insurance you've bought, 80, 85, 90%. And then you take a coefficient of 55% to figure exactly what your prevent plant payment is. For my clients I've worked with, that can range from $320 to $400 per acre.
So there's a discussion as to whether they can get it in versus insurance and whether they can actually get it in physically. So Dan, thanks for your insight. We'll keep a close eye on the market. Thanks for joining us on Market Movers. I'm Dave Hightower. Trade well and trade smart.